Welcome, everyone, to the Intequity Podcast, where investors and developers learn how to get their deals capitalized. I'm super excited to have RK Kleibestein with us. RK is a 40-year veteran in the industry of self-storage. He's had the blessing to lecture all over the world. He's authored 3 books on self-storage facilities. Mergers and has been involved in mergers and also was with Extra Space. He's probably worked with over 10,000 developers. So I'm thrilled because there's nobody I know doesn't have the qualifications that RK does. So RK, thanks for joining us today.
Thank you for having me, David. I appreciate it.
So I'm just going to dive right in to self-storage facilities. What would you say are the key factors driving demand for self-storage in today's market?
You know, David, we as consumers just love stuff. I think about George Carlin back in the day, and he did that little bit on stuff, and things have just really never changed. And even as our economy flexes and gets better or worse, we still love our stuff. Self-storage is it's an event-driven business, and it's usually polar opposites. It's marriage, divorce, it's birth, death, it's found a job, lost a job, bought a house, sold a house, all the things that occur in life cause us to use self-storage. And that's why about 1 in 8 people in the United States have used self-storage at some time during their lifetime and continue to use self-storage going forward. It's a very active component of American life. And now we see that same kind of proliferation of use of self-storage in foreign countries as well. But domestically, we continue to use self-storage. The pandemic was very, very good for our business. We flourished during the pandemic. Now we're kind of feeling the after effects of that as the glow and the hue has worn off a little bit. But the business is still strong, and it continues to have strong metrics and continues to be something that Americans just use. And as long as they continue to use self-storage, the industry should be just fine.
Yeah. When you dive in and analyzing a market, how do you determine if something can actually support it?
So there's a number of different ways. The old school method, which is still used a lot by financiers and lenders and whatnot, is the old square foot per capita. And that's a benchmark that is not a demand metric. It is truly a supply metric. It only tells you how much is there. It doesn't tell you how much is going to be absorbed. And my favorite example of that is Las Vegas. I'm a 4-time previous Las Vegas resident. And we never would have built more self-storage in Las Vegas if we'd have used that as a cap, because at the time, I believe the first time I was in Las Vegas was in the early 90s. And we were already almost triple the national supply metric, which I believe at that time was around 2.5 square foot per capita. And we were already close to 7, but we were absorbing space and building new space and continued to do so well above the metric for supply. And that's because the demand was much higher than the metric for supply. So to me, indicators, the KPIs to me, are occupancy and rental rates. If rental rates are going up, it tells us that there is room for more product in that market, because until rental rates get flat or start to decline, those are the key markers that there is oversupply in the market. If occupancies begin to drop or there's not absorption of new product, that tells me that there's an oversupply. But until those two things exist or coexist, the market still will absorb more space.
Would you say that that's some of the biggest mistakes that investors make when it comes to assessing a self-storage facility, is not understanding those two metrics?
It is. And part of the problem is that data is not readily available. It's the holy grail of information when it comes to self-storage information, because it's not public information anywhere. For a long time, David, operators didn't even want to give rental rates. They were like, the whole secret was how much I charge for a 10 by 10 to a consumer. They weren't even willing to give the information. It was like, keep it on the down low that we actually charge for a 10 by 10. It was craziness, and it still is craziness to some extent. But the point is that information is not readily available. Now, on a macro level, it's available in the REIT quarterly reports and in the annual report, but it's still not available on a granular level. And because of that, developers don't know truly what the occupancy is. And so we have to kind of use workarounds to get there. I have methods that I use when I'm doing a feasibility study that are pretty darn good for determining whether or not the occupancy is there. But it's not easy to get. It's very laborious. It's time consuming, but it's the only true way to get that information. And it just takes shoe leather, David. It takes time and effort to get it. And, it's just one of those things that it's a learning process. And developers, it's not easy to do it. It's not the easy way to do it. So they tend to gloss over.
I would imagine so. Let's talk about technology. Technology, obviously, everybody's talking about AI. Everybody's talking about how technology is going to be the next thing, automation. How has technology, if any, affected the industry? Like, what impact do you see that having in terms of like underwriting a deal?
So, the beautiful part about technology is how it gathers data and how we use data. If you're a publicly traded company like Extra Space or Public Storage or CubeSmart, you have big data. You have tens of thousands, hundreds of thousands, millions of customer interactions that you can cull that data, you can manipulate that data, you can use that data for predictive analysis as to what the customer behavior is going to be. That tells you when you can pass along rent increases. It tells you how much your rental increase can be, what the frequency is, when the customer is most likely to accept it, when they're most likely to move as a rejection factor of too much rental increase, too often rental increase, all of those designed metrics that make our business what it is. Because self-storage is just like an airline seat. It's just like a hotel room. It's just like a car rental. It's a supply and demand factor. When the demand is high, the product is more expensive. And the only way to do that is to have big data behind you. I feel for operators who only have one store and they're trying to do this with an Excel spreadsheet, or they're trying to do it with really, really poor tools that don't give them the operating metrics to be able to do that. That's where technology really shines in our business, is the ability to use that big data, crunch that data. Back in the not more than a decade or so ago, Extra Space was using 10,000 customer strips to test timing and frequency and percentage of rental increases. And when you can take 10,000 strips of customers, you can really understand how the customer reacts to it, right? Because you're testing customers who have only been there a year, and you're testing customers who have been there 10 or 15 years. You don't have that ability in a single operator or a 5-store operator, or even a 20-store operator. You just don't have the ability to do that.
Yeah.
The second part of it is you don't have the ability as a management company that only has maybe 30 or 40, and I say only, but it's pretty good scale. Even if you have 50 stores, it's hard for you to hire a guy who gets paid $1 million at an airline to come to work for you, to design the algorithms to generate the formulaic that drives the rental rate increases, right? It's hard for you to build a team that does that. It's hard for you to buy the computers that do that. And so that's why the REITs are so far ahead of everybody else in technology, because they have the resources and they have the data to do this. And that's where technology plays its biggest part, because there is nothing else that is important to self-storage as managing the rental rate increases. We call it ECRI, existing customer rental increases, those rate increases. That is the absolute key to the ownership of self-storage.
That's great. How do you determine, when you're looking at buying a facility or building a facility, how do you determine, that's always the magic question, unit mix? What kind of unit mix, sizes for particular market? What is your process of going through that?
So there's actually two kind of methodologies that are used. A lot of guys out there have a set formula that they use, and all they do is size it to the building. And I don't do that, David. I start with a blank Excel spreadsheet every single project. The first thing I'm going to look at is the configuration of the buildings, because if you have ambient drive up, your unit mix is going to be much larger than if you have a multi-story climate controlled building. Just by the configuration of the building, it's going to change the dynamics of what your unit mix is. The second part is your demographics are definitely going to change what it is. For example, if I'm in New York City, if I'm in Manhattan, my average unit size is probably going to be somewhere between 48 and 57 square foot per average unit size. If I am in Tucson, Arizona, and I'm out on the outskirts of Tucson, probably going to be 120 to 130 square foot unit size average. It's entirely different depending upon your location and your demographics because of what people are storing. If people live more densely, like in Manhattan, an 800 square foot apartment, that's a pretty standard apartment for people. Whereas in Tucson, it's maybe an 1,800 square foot apartment. That's because they have more stuff, right? So they have bigger space needs. So the way they live is the way they store. If you live horizontally, you're more likely to store horizontally. If you live vertically, you're more likely to store vertically. Those things impact your unit mix. And then lastly, it's the market itself. What is the most acceptable in the market? I remember a guy by the name of Wendell in Alabama who built one of the first climate controlled single buildings with climate control units on the inside of it. Everybody thought Wendell was the craziest guy. They thought he was Wacky Wendell is what we called him. Now you'll never rent that stuff, Wendell. Nobody's going to go inside of a building on single story to rent climate controlled units. We then called him Wise Wendell after that because he figured it out. He knew that people would do that. And they did. If you build it, they will come. And they did, David. They did come to store that way. But that's because that's how people were living. They were living single story. And so they wanted to store single story. They had quality of merchandise that needed to be stored in climate control. And he met that need. So it just depends on how you adapt to your market.
Good job, Wendell.
Yeah.
So let's talk about financing. So you find a location, you figure out a market, you're looking at those elements, and now comes the tricky part. How do you finance a self-storage facility? So what are the options that are generally available to people that you've seen historically?
So I'm hoping, first of all, that they're not putting the cart before the horse and they're trying to find the property first. I think they should have their lender pretty well lined up before they even go to market to find it. They should be talking to a guy like you to see what their options are. And it could be everything from on an existing property, a life company. Maybe it's a fully stabilized Class A property that is parked at a life company that has the best of rates, has a good advance rate as far as loan to value, maybe tempered today more by debt service coverage than it is loan to value or by a debt yield. Any one of those metrics may cap the dollar amount that's there. Right behind that, it may be a conduit loan, maybe a securitized loan. There's a number of places you can go to get that. The SBA guaranteed loan, those two programs that are available for self-storage, both of those are really, really good options right now. And then lastly, you could just go back to your traditional commercial bank. You might be going to not lastly, there's a couple other options. You might go to your traditional bank. You're probably going to have a personal guarantee on that. You may be able to burn some of that guarantee off, but it's going to be a recourse loan most likely. So, you better be prepared to pledge your assets in order to get that. Maybe you could do a credit union loan. There's a number of commercial credit union loans out there that are very, very attractive. They have nice burn off prepayment penalties, if any. The advance rate is not quite as good on a development loan, but it is out there and it is available. There are debt funds you can go to. If you're willing to pay the double-digit interest rates, you can get very high leverage in the marketplace. It is what suits your needs best is really what it is. If you need high leverage, you're going to pay higher rates because the risk profile is higher. If you have a fully stabilized property in a Class A market in a Class A, you're going to pay less rate and you're going to have a more attractive loan. It just depends on where you're at in the spectrum. But I would encourage someone to know well ahead of time what their business plan is, what kind of product they're going after, whether it's they're acquisitive or they're developing, what kind of product they're going to be building, whether it's boat and RV storage or it's traditional self-storage, and then have their lender completely lined up well before they go into the marketplace to actually find a location. They should well know how the lender is going to stack up so that they can begin to roll very quickly.
Yeah, I agree. People should not only have their debt lined up, but they should also have their equity lined up. It's
Amen,
really,
brother.
really imperative that prior to somebody coming to you or whoever to identify a site, that they have actually gone through, raised the capital, have it prepared and ready. And I know there's a little bit of chicken and the egg, but that does need to be in place because otherwise it's going to slow or stop the process completely down at this present time.
One of the things about the equity, David, is the first question I'm going to ask you when you come to me. One of the very first questions in terms of feasibility is I'm going to ask you, what is your return threshold? What do you expect for a return? And is it going to be an internal rate of return because you're looking at an exit strategy? Or is it going to be a cash on cash return? Is this going to be a discounted cash flow analysis? Is this going to be a developer's yield? What return do you need? And you really can't determine what return you need unless you know where your equity is, unless you know what the capital stack looks like. And so to me, feasibility is, does it meet your equity threshold? What return you need? And so that's the true measure of feasibility as far as I'm concerned. You can rent space all day long. You can have the best market in the world, but if you need a 15% IRR and it kicks 14.5, it's not feasible.
Yeah. How do you I mean, on that same note, how do you, or maybe better said, what is a realistic internal rate of return on average that somebody should expect for self-storage if they're a investor? And what I mean by that, if it's an LP investor coming in to get an IRR, what does that look like?
I think we kind of shoot for the moon, and the moon looks like a 15% IRR if you're internal rate of return driven. The mid-teens is kind of the area the the traditional family offices, private equity guys, they're all looking for that mid-teen return. With interest rates as high as they are right now, we're in a bit of a pickle right now, especially on the acquisitive side, where if you're trying to park money in a Class A fully stabilized property, you're in negative leverage right now. The interest rate that you borrow at is higher than your return rate because the cap rate is so low still. And until there's an equilibrium that's reached there, we're going to still continue to be in negative leverage. But in a development project, you got to be developing to a developer's yield. I think somewhere in the 8 to 8.25, 8.5 would be a nice range for a developer's yield. A internal rate of return in the mid-teens. I've seen guys that say, "Hey, I got to have a 20 plus internal rate of return, or I can't make this work." Well, it's darn tough with high interest rates to get to a leveraged 20% plus project right now.
Yeah.
Especially because in this burn off of the pandemic, remember I said at the beginning of our conversation that we're feeling the effects of that overexuberance from the pandemic. I can go to almost any market in the country right now, major market in the country. I can pick submarkets in there, and I'll bet I can find at least double digit, if not up to 20% reductions in rates over the last trailing 12 months. That has a tremendous impact on the forecasting of where your rents are going to be in a development project.
It's true. I mean, all those have tremendous impact. Obviously, saturation does as well. So if I'm going in, how's a lender going to underwrite? I mean, they're going to look at a loan to cost in this particular market. Obviously, the interest rates that we're dealing with right now have an impact on how much you're going to have to put down versus what it used to be before, because debt service coverage ratios typically are in that 130 plus DCR, meaning if you have NOI of X and that's break even, you've got to have a 30% cushion of that NOI over the debt payment in order for a lender to be comfortable with that. But what types of things should somebody be cognizant of that they're going to underwrite to in order to get a loan done?
Well, they're going to look very, very, very critically at your projections for your rental rate increases, especially if you're bringing them a project that has had double-digit decreases over the past year. You're going to have to tell them how you're going to turn that around from a negative to a positive, because if they take a one-year trend and they've got a chart and that graph has a negative trend, you're going to have to explain to them how we're going to reverse this. Now, David, the practicality of it is that in our industry, any downturn we've always had a great uptick at the end of the downturn. Now, it's the timing of this that we're dealing with. When is it going to turn and go back up again? And David, I am on record probably a dozen times of saying, we've reached the end. This cat has had its ninth life. There's no way we're going to recover like we ever have in the past. And every single time, David, I have been flat wrong because our industry came back stronger than it did ever before. I don't care whether it was the pandemic, the great financial crisis, the Great Recession. the savings and loan crisis from 1986, or the Tax Reform Act of 1986. You name it, the tech bubble, it survived every one of those and came back stronger after each one of them. I have no reason to believe that the current situation is not going to rebound exactly the same way. And all I can do is tell a lender, you tell me when it's not going to do the same thing it's done the last 15 times we've had any kind of flattening or downturn. It has performed exactly as we have hoped it would do and have watched it do. So that means all we do have to do now is believe that history will repeat itself, and then let's pick a time frame when we think that's going to happen. So I asked the lender, when do you think interest rates are going to normalize and come back down to that 5 to 5.5% level for a commercial mortgage? That's when I will tell you that the housing market is going to rebound. And when the housing market rebounds, that's when the storage market will rebound. Because the number one reason people use self-storage is related to a residential move. So as soon as we start moving residentially again, we're going to have a tremendous rebound in self-storage. So you tell me when that's going to happen, and I'll tell you when you're going to see the rebound in self-storage. And we can project then that negative growth in rental rates is going to reverse itself, and we're going to see again a large positive trend going up.
It's a good word. Let's talk about construction and development. What would you say are the biggest challenges in developing a ground up self-storage facility?
Well, the risk has always really been your site work. I mean, that's because you just initially, when you go into it and you buy the land, you may not always have had all of the tools that you need in all the arrows in your quiver that you need, which is typically your geotech reports, because that's going to be the soils report is largely going to be the biggest determiner of what you're going to need in terms of soils to control costs. I mean, we can kind of look at the topography. If we've got a good ALTA survey with the right addendums checked on it, options checked on it, we're going to know what that looks like. But until you start doing borings and you start figuring the hydrology of it, what the quality of the soils look like. If you're in Georgia, I just had a site in Georgia that the guy hit rock in it, and it's going to be $1 million to get that rock chipped out of there in order to get the footings in that he's going to need to do a 4-story building on it. I mean, you just don't know that unless you've done all of your homework up front, and that's expensive. We're talking about $9,600 for a 1.5 acre site to do the borings we need for the geotech report. It's also time consuming. That means you've got to have a negotiation with your seller on the land that you can get enough time to do all of those reports and get them done. Getting the site work, getting it through the city, getting a civil engineer to get your site plan approved, all of those things will get you a better quantifiable cost of your site work and the cost of building the project. The other issue that we're facing right now is what's going to happen with the tariffs. Because most of the rolled cold steel that's used in self-storage, and let's face it, most self-storage is a metal building, whether it's the red iron framing that goes into it, whether it's the steel that's going into the concrete for the rebar, all of that is typically coming from China. Well, we had tariffs before. The tariffs were released. Now we're looking at tariffs again. When we thought we were going to get Chinese tariffs again, we shifted and said, okay, we need to start buying that from Canada. Well, guess what? We didn't really think until we saw the presidential election and we heard it from the lips. I don't think anybody really thought that Canada was going to be a tariffed nation. Yeah. If now we negotiated all this potential steel to be bought from Canada and we're going to get hit with the same tariff in Canada, potentially we would have from China, that's going to impact our costs. It impacted the cost potentially of a project that I just looked at this week. It's over $1 million in cost on a very, very large project in an urban market. I mean, it is a big cost determination. Look, if you've already got your construction loan and you've already raised your equity and now your price goes up $1 million, it's what I would call a problem. Mm-hmm. I mean, as a lender, what do? I mean, if it's already baked and now you go buy your steel and your steel's $1 million more, how do you do that except go to the developer and say, got to come out of your pocket?
Got to come out of your pocket with more cash.
Exactly.
The math just doesn't work. And then you're diluting your IRR and your investors. You, Lord willing, get past this position of building something, and now you're leasing up and you're in this operations mode, what are the key operational drivers that you would say separate a successful self-storage facility from a struggling one?
I go back to a conversation we had earlier, and it's really the operating metrics, and it's do you have the right operator? And I then go back to the statement that I think you need to be with a major operator who has big data that they can use for the ECRIs. Because, look, we can project what the going in rates are because they're published on the internet. Almost everybody puts their rate out. We can tell what their street rate is. We can tell what their walk in versus their web rate is. But those are highly discounted just to put butts in the seats. We can look at Extra Space or Public Storage, and what used to be a $150 10 by 10 is now $55. But we also know that 4 months from now, they could be getting a $80 or $90 rent rate increase, that they came in at that $55, but they're going to move those rates up as quickly as they possibly can. It's the knowledge of knowing how much they can press those rates before that tenant moves out
Yeah.
that is the key to it. So that's why you have to have a really, really good operator. And that's why, and I would think that a lot of lenders would require that you have a third-party management company that is competent to run this property, particularly if you don't have any experience running self-storage, because it's a very active business. In fact, the fact that the SBA will loan on self-storage tells you it's not really a real estate play, it's an active business play, right? Because they won't lend on investment real estate. They lend on active businesses. And that in itself is a tell that this requires management. It used to be a quote unquote cash cow, used to be a no brainer business. I don't believe it anymore. I haven't believed it for the last 20 years. I see what it takes to make a successful property. And it takes algorithms, it takes management, it takes good and prudent oversight of the operations on a daily basis. It takes good computing power to do that. Back in the day, we used to run our sites on what was called the Trash 80, a TRS 80, a Tandy 80 from Radio Shack. That's what controlled our gates. That was the only computer we had on site back in the early 90s. Now, we're using big data. AI is going to transform our business. We know now that our peak time is Friday afternoon at 3 o'clock. That's when our customer gets locked in. We know that 10 o'clock on Tuesday morning, the phone's probably not going to ring. So all that comes from customer experience, consumer experience, from what happens behind the desk. That tells us how we staff. It tells us where our specials are. It tells us about channel marketing. It tells us about all the things that we need to know to properly operate self-storage. I don't think you can rely any longer on an $11 an hour manager to tell you how to manage your business. And that's how we used to do it, David. We used to rely on a manager who had no college education, who maybe had some experience in the business. They told us how to run $9 million assets. Not anymore, David.
Well, I think the positive side of that too is it's creating more pressure to operate at a higher level, henceforth, hopefully a better experience for the consumer when all is said and done.
Tide rises all boats.
It does. It excites me. So the competition will pressure point to see who's going to be the best.
And the other thing is, David, you have a built-in exit strategy with the REITs, because as soon as they start writing checks again, if they're already managing your property, you have the best and most likely buyer for your property already in your property and knows it very, very well. And they're not going to try and lowball. It's never been my experience that Extra Space, CubeSmart, or Public Storage has tried to lowball an owner on buying their property. They will typically come with a very fair offer and a market offer in order to buy that property. And they're also not likely to, I guess the old saying was, blow a bunch of wind up your skirt and tell you that they're going to give you this price that they're never going to deliver on and then try and retrade you. That's not how they operate. And so, you have a lot more confidence that you're speaking to someone who's going to close at the number they say they're going to close at. And they're already familiar with the property, so their due diligence process is expedited.
Yeah, it's fantastic. So as we land the plane, two more questions here. What today, right? What cap rates are you seeing in the market for stabilized self-storage facility properties? How's that changed in the last 12 months?
So I think it's inched upward. We were seeing really, really, really strong stuff closing, maybe even sub 5, and that 4 and 7/8, 4. I saw some 4.5 cap rates close. We had some chicken on the bone. some meat on the bone there to give it something going on. I think that number now has inched well closer to 6% cap rates. I think that's where the market kind of sits now as I look at the transactions that are trading. Really important to me is I look at transactions online and then I look at the second email that comes out and it says price reduction. And that's what I'm seeing. I'm seeing more and more properties not trading the first time around. They get to the call for offers and the market pricing is not where the seller wants it to be because they're still living 9 months ago. And now they're going to take, I'm going to hold my breath. Okay, I'm going to go for another round now. Let's see if we can get it. We get a price reduction out there and a new expectation gets set. I think that's all just a function of the market. It's kind of a reaction to the higher interest rates. Look, if I'm paying a higher interest rate, it's going to dilute my yield. Now I've got to have some kind of adjustment in purchase price. And it's just a trickle down effect, right? That, at the end of the day, that's all it really is. Is self-storage worth less today than it was 3 years ago? I don't really believe fundamentally it's worth less. It's just a function of capital stack. That's all it is. The capital markets dictate where we are. Capital markets made us uber wealthy. We didn't really do much in self-storage to get there. We just showed up, right? We took some risk. We showed up. Capital markets made us wealthy by the virtue of the cap rates coming down. Now we're seeing some adjustment. They're taken back a little bit, right? He who giveth taketh away. He who taketh away giveth. All we're doing is a little bit of the giveth right now, right? And the taketh away is there. So let's just adjust. Let's wait for the industry to get healthy. As soon as residential real estate starts moving back again, I think all things will become equal because the tell for residential real estate, I believe, is a giving of the interest rates. All things work together for the perfect plan.
Yeah. Final question. So if you're starting over self-storage facility in the industry today, what strategies, what advice would you give to somebody who's diving into it?
Well, first of all, get your capital stack lined up. I mean, that's the most important thing. Know where your debt's coming from, know your equity's coming from. If you're using partners for your equity, know who your equity partner is. Make sure that you're evenly yoked with them. Make sure that you have an idea that you both have the same exit strategy in mind, that you both have the same operational strategy in mind. Make sure that you both know what the ugly wife clause looks like because stuff happens, death happens, divorce happens, all kinds of things happen. And you need to know who you're going to be doing business with in the event of a tragedy in your partnership. And no one wants to have to deal with negative things in it, but you need to be able to plan for it. Because if you don't plan, then you'll fail. And if you fail, it's probably because you didn't plan. Let's look at some of those eventualities. So know who your partners are, if you have to have partners, and make sure that you work through with all of the eventualities to have at least some kind of contingency plan so you know what to do in the event of some catastrophic failure. The other thing is you've got to have a good operational plan. I mean, you need to know how you're going to operate these properties and what your exit strategy is. If you're going out a certificate of occupancy, then the operational side of it doesn't really matter because you're turning it before you actually have to open the doors. But if you're going to get to stabilized occupancy, your capital needs to line up with that timing wise, right? I mean, the incubation period for self-storage is very long. If you've got a 3-year loan and you think you're going to exit at stable, you're not even going to exit probably at certificate of occupancy at that point. I mean, it's very possible you'll barely make certificate of occupancy at 3 years. So that's why you need to have a mini perm where you can roll it over to some kind of operating. Probably going to be a 5-year loan today. Might even be a 7-year loan to get there. You might need to negotiate a couple of 1-year extension options beyond your 5-year loan to get you to fully stabilized cash flows. You may reach physical occupancy without a problem, but I don't know that you're going to get your economic occupancy. You're going to burn off all those discounts and concessions that were given to put all those butts in the seats. So it is a long-term play. That has been one of the problems with self-storage is in the world of commercial real estate, there are the tortoises and the hares, and it has never been a hare. It has always been a tortoise. But you know what? It crosses the finish line with a lot less risk than a lot of those hares because the hares burn out. And this has been a great tortoise. It's got a great shell on top of it. It's a hard shell, right? It weathers the storms. Didn't I say it's weathered every single storm?
Weathered every storm.
It's that hard shell.
Ups and downs.
Exactly.
You
So
know, yeah, go ahead. Sorry.
no, I was just going to say, so that's it. Make sure that you have a really great, good business plan, that you vetted that plan against the eventualities. You shared that plan with sophisticated operators who have taken a look at it and said, yeah, maybe you ought to tweak this part of it, or hey, let me share an experience I had along the way when I was first getting started. Let them give you some insight. You ought to be attending trade shows and conferences so that you get exposure to other developers, that you're rubbing elbows with other guys who are in this same process, who have been in the foxhole at one point, and they can help counsel you and guide you to the right way to get it done. There's a lot of industry experts out there who are willing to share their experience and their expertise with you. Use a good consultant. I have some good colleagues in the business that are my competitors. They're really good guys and gals out there that know their stuff. Make sure your management company is top flight, that you've asked them the tough questions. Make sure you manage the management company. I just wrote an article about a white paper about managing the management company, because you'd be surprised. The squeaky wheel gets the grease. If you just let them manage it, you're not going to get the best of managers necessarily. You're not going to get the attention necessarily. So all of these things play into an active part of be a good owner. That's all I can tell you, David, from the time you start thinking about getting into self storage till the time you take that check away from the title company.
Yep.
Be a good and prudent owner. You are being given the opportunity to be the steward of something very, very good. And that stewardship, with stewardship comes responsibility.
Yeah.
And that's all I can say is be responsible as an owner.
Yeah. Be a good steward, good wisdom, good advice. Really helpful from a premier expert in the self-storage space. Been doing it for 40 plus years and seen all the different scenarios. And so thank you, RK, for taking the time to educate us, give us insights as to the market, the financing, the construction, the operations. Really, really helpful, because again, our aim here is really at Intequity Podcast is investors, developers learn how to get deals capitalized, and you need the whole thing in order to do that. So thank you so much for your time and your expertise.
Thanks, David. You have a great one. God
You
bless.
too, sir. God bless.